Welcome back to part 6 of chapter 2, where we're going to be covering interest income. So let's take a look at the 1040 form. And we know the common types of income are listed here on the front page of the 1040, including here in line 2, interest income. You notice again there's boxes to the left, and then the main boxes are here to the right, which is being all totaled up to get our gross income or total income figure. In the case of taxable interest income, we would just add it up on our own and then put the total here in line 2B. What we're told here in line 2A is an amount for what we call tax exempt interest. Exempt is just another word for non-taxable or excludable or tax-free interest income. And if you want to earn tax-free interest, the place you would go is probably a broker who sells what we call municipal bonds. Municipal bonds are sold by either states of the US or counties or cities or other territories of the US. And when you earn interest on those bonds, you still have to report it here in box 2A. But because it's not going to be included here in the right-hand column, it's going to be income tax free. Now remember back when we covered the Social Security amount being calculated as taxable, we would have to add back this tax-free interest in what we call the modified adjusted gross income and maybe make this Social Security benefits more taxable here in the right-hand column. Our textbook goes through a calculation of how to figure out which is better, earning interest that's tax-free or earning interest that's taxable. And of course, if it's the same percentage, you probably would want to earn tax-free interest. But because tax-free bonds are more desirable, they're going to probably pay less interest than places where you can invest having taxable interest. So our textbook goes through a calculation to be able to compare which one is better for our taxpayer. I'm not going to illustrate that here in this video, but just make sure that you know that the tax-exempt municipal bond interest is reported here in 2A, and it's not included here in box 2B. Now, if the interest is reported to our taxpayers on this form called a 1099 INT, and here is the bank or the credit union or the savings and loan, could be even the state or federal government paying interest to our taxpayer. And the amount of taxable interest would be reported here in box number 1. Now, if the interest is coming from a federal bond, a U.S. bond, or something they call treasury notes or treasury bills, then the interest would be reported here instead in box 3. The reason why they separated from box 1 is that even though both interest box 1 and 3 is taxable on the 1040 form, it's probably going to be this box 3 interest tax-free when preparing the state income tax return. Again, box 1 and box 3 is taxable to the federal government on the 1040 form. But this box 3 should be tax-free when you prepare the state income tax return. Now, remember we talked about the tax-free interest, the tax-exempt interest. That's reported to the taxpayer here in box 8. And again, back on the 1040 form, the tax-exempt interest would go here, and all of the taxable interests, including the ones coming from the federal government, reported here in box 2B. On the 1099 form, some other boxes you may see. is these items called discount and premium. If you've taken another accounting class learning financial accounting, maybe in the chapter regarding bonds, you learned about discounts and premiums. Discounts will cause our taxpayer investor here to have more income because they bought the bond at a lower cost. And when the bond matures, they're going to get the regular face value costs, increasing the amount they collect. That extra they collect is more interest income. Or if they bought the bond at a higher price, here called a premium, they're not going to get back the premium they paid. They're going to get back the regular face value price of the bond when it matures. It may sound backwards to accounting students who again who taken a previous accounting class. The reason why is because we're taking the viewpoint of the investor here, our taxpayer. And in the financial accounting class, you learn the viewpoint of the company that issued the bond. Okay. Again, we're not going to go through any calculation to determine the amount of discount income or reduce interest from the premium. Yeah. Another type of place you can get interest is to go to the financial institution and purchase what they call a certificate of deposit. They use the letters CD, certificate of deposit. And basically, what you're doing is investing your money for a set period of time, like 1 month or half a year or 1 year or multiple years. And you're not going to be able to get back your money plus interest until the certificate matures after that period of time. If the maturity date is 1 year or less, you would just wait to collect the money and the interest, and it will be reported to you over here in box 1. If you have to wait more than a year to collect the interest, then you may need to report the interest that you earn by having collected at the end of each year. Now, if you cannot wait to when the bond matures, you can still cash in your bond, but the bank, not the government, will penalize you. And that penalty will be reported here in box 2. And you'll be able to claim that penalty you paid as a deduction, as an adjustment deduction. And we'll learn more about that in a future chapter. I think that's all we need to talk about here on this 1099 I and T form. Back here in the 1040 form, if the interest that you earn from the bank is less than $10, they're not required to send you a 1099 form, but you still got to report it here in line 2B. Now, if the total amount of interest you get is more than $1,500, what you have to do is now list out the different places you got the interest from. So attached to the 1040 form, you would have to include this Schedule B, which has 3 parts. The first part is for interest income that we're covering now. And in the next video, we'll talk about dividend income. And the third part talks about if you have any kind of foreign accounts, foreign investments. Here in part 1, we would just list out the name of the bank, the name of the financial institution, and then the dollar amount over here. And then take a subtotal. And in the next line, line 3, is not a common type of situation where people cashing in their U.S. savings bond, if they use the proceeds for education costs, they will be able to reduce the amount of income, taxable interest income they're reporting. Again, the interest income would be up here for the savings bond. And if you use the proceeds of these bonds for education, you'll be able to subtract out the amount of that interest. In my whole life, I've never seen this done. There's probably better ways to save for education. Okay, and then this grand total down here would be reported back on the 1040 form here in line 2B. Okay, talking about savings bond interest. Again, that's the usually the EE bonds or I bonds. Okay? Not treasury bills or notes, yeah, but US savings bonds. Usually you don't have to report interest, at least on the EE bonds, until you have the bonds mature or when you cash it in. So it's increasing in value every year, but you don't have to report that increasing in value until you cash in the bonds. Or a taxpayer could elect to report the interest income on the savings bond as it increases in value, even though they haven't received it yet. Now, why would you do that? Why would you report savings bond interest early and not just wait till it matures or till you cash it in? Well, a lot of these savings bonds are given to babies, young kids, as a gift, either by the parents or grandparents or friends. And these young kids are not earning any income at all. But if you remember back in chapter 1, everybody gets a standard deduction. And the smallest standard deduction someone could have was that $1,100 amount. And if you're not using it, it's going to go to waste each year. So one way to take advantage of this standard deduction for your small kids is to elect that any interest earned on a savings bond will be reported as it increases in value over their lifetime and start using up this 1,100, possibly paying no taxes at all. And then when the bond matures or when they cash in that savings bond, because you already reported the interest, you don't have to report it again. It should be already paid for. Okay, that's US savings bond. It doesn't apply to any other type of bond. Okay, that's interest income. Again, you fill out this Schedule B if the interest is over 1,500. If not, the interest is still taxable. You just write in that total taxable interest here in line 2B. Okay, continue with the next video where we're going to be talking about dividend income. Okay, see you later.